This is InvestTalk. Independent thinking, shared success.
Hey, Justin or Luke. This is Dan from Walnut Creek, and I had a question on ConocoPhillips, ticker symbol COP. And I was wondering, I should hold on to this, or if you think that the prices might be going down in lieu of the drill, baby, drill that President Trump keeps on talking about. Thanks very much. Bye.
So we own ConocoPhillips for some of our managed accounts, and so we like it. One of the reasons we like it is because they have a pretty large amount of natural gas exposure, and we like exposure to natural gas, as we think that's now the new swing energy molecule that's out there. It used to be oil, but because natural gas is so abundant, especially here in the United States, and it's now a lot easier to export natural gas, that's really the swing fuel in today's market. And so we really like exposure there. And ConocoPhillips, they have a strong balance sheet and strong cash flow, $9 billion in free cash flow trailing 12 months on $120 billion market cap. That's a pretty healthy free cash flow yield. Pay a 3% dividend, and with our payout ratio only 40%, that dividend amount can continue to go up, and we expect it to. Now, if you look at the number of shares outstanding as well, what are they doing? Well, they're buying back shares as well, especially since 2021. So we really like ConocoPhillips overall. Now, when it comes to your second point, is the drill, baby, drill. I wanted to address this because it's something that so many people are talking about, and I think it's a bit overblown. Yes, Trump can make it easier for companies to drill, but he can't force them to drill. Now, maybe at some point he does, right? Ties some sort of tax credit or whatever to them actually going out there and drilling. But until then, it's a lot of rhetoric, and there needs to be incentives for these companies to actually drill. And that means higher prices. And so I think you're probably stuck in a range, though, in oil between call it $70 and $90 a barrel. But you're generally going to see natural gas prices rise. And so that's where I think there will be better opportunities in the market. And if you want one of the big majors, right, then I would say ConocoPhillips is up there with one of the best with exposure to a lot of parts of the E&P space, but mainly natural gas exposure. So I would give ConocoPhillips a thumbs up if you want energy exposure. But when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for their courtesy by getting to their questions quickly. And Duncan from New York left a review, thank you, and said, please review the stock ticker HWM. And this is, I believe, Howmet. Return on equity is over 20%. Yeah, Howmet Aerospace. And it's pretty expensive. But if you look on forward-looking earnings, $3.18 on $127 stock. That's a low 40s forward-looking multiple, but its relative strength is very high, 95% on that front. Obviously, very good. But the question is, has it gotten too far ahead of itself? And that's the tough thing with these expensive names. They're momentum names, and that momentum can certainly keep going. It's overbought currently. But if I zoom out to a weekly chart, you're definitely seeing some of that momentum wane, not in a major way, but a minor way. Now, what does Howmet do? They produce products mainly used in aerospace, commercial transportation, industrial markets, etc. So I like the business, definitely like the business. I believe we've owned some bonds related to Howmet in the past. Right now, $1 billion in free cash flow, but a $54 billion market cap. Very little debt, which is good, but that free cash flow yield is only at about 2%, which to me is a bit extreme. So to me, this is a name you absolutely keep on your watch list. And if you want to play it for momentum, fine. But this is a name that once they have one earnings report that doesn't meet growth expectations, that's when this will fall. And the issue here is you're having earnings momentum accelerate. Earnings for 2024 full year expected to be up 45%. But this year, earnings up another 19%. So you're seeing growth slow on that front, as well as on the sales side. Roughly a year ago, you had sales up 21% year over year. And now it's only up 11% last quarter, and this quarter expect to be only up 9%. So that growth of earnings acceleration is, I think, slowing. And that's typically when you get a re-rating. And this is the type of name that, probably should trade at a premium to the market because the quality of its balance sheet, the quality of its business, quality of profitability, et cetera. But should it trade at 40 times? Probably not, when earnings are growth is probably going to decelerate to an above average level, but still probably mid to low teens. And that probably warrants a multiple in the high 20s to low 30s. And that's where you'd want to pick it up, but not here unless it's just a pure momentum play. I think you missed the boat in the near term. For any long-term hold, I'd be waiting for a pullback and keep it on your watch list because it's absolutely a good company. So like what you're looking at, just be a bit patient on it. Now let's keep things going and play another caller question now.
Hi, Justin. My name is Robert, and I'm from Florida. I just wanted to say thank you for all that you guys do. Great show. I learned so much from just listening to you. I just have a quick question about Schwab U.S. Large Cap ETF. Ticker symbol is SCHX. I might be interested in buying a couple of shares, and I would like just to get your input on it and just to see how that is. Again, thank you so much for all that you do. Have a great day.
All right, looking at the Schwab U.S. Large Cap ETF, SCHX is the symbol, excuse me. Now, you can see my screen. If you head over to YouTube, you'll see me sharing my screen and all the data. And right now I'm looking at Morningstar. And what you can see, this is just a large cap blend. You have a fairly even balance between growth and value here. It's all domestic. Largest holding is NVIDIA, Apple, Microsoft. So this is very similar to owning the S&P. It's a little broader, 750 names versus 500 names. So that's a positive, but you're still very overweight tech, 32% of the portfolio. It's actually even more overweight tech than the S&P. So I'm not a huge fan of it. I think there's better opportunities out there for your money.
Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox.
Now let's go take a live call, and this one is from Sherry in Pennsylvania, looking at BMY, Bristol Myers Squibb. Do you own it or looking to buy it, Sherry?
Looking to buy it. Looking for a cheaper pharma stock, and this one looks like a good value. So I want to get your opinion and what would be a good entry point.
Okay. And when you say it looks cheap, what metrics are you looking at?
The P ratio.
P ratio. Okay. So based on 2023 earnings, made $7.51. 2024, though, it's only supposed to make 90 cents. So based on that, it's definitely expensive at $59 per share. But this year, 2025, expected to make $6.96. But that's still down from the $7.51 just a couple of years ago. So obviously, it looks like this year is kind of an anomaly, but clearly their business trajectory is negative. And that's my issue. Now, it has come down pretty dramatically. It peaked around in the low 80s, hit a recent low around $40 per share, now bounced up to 59 about. So you're kind of in the middle of that range. Now, the question is, at about $7 in earnings this year, is it cheap? And based on a earnings multiple, that's about 8 times. However, earnings estimates from analysts for this year continue to come down. So while it's still nearly 696, that trend is lower, and I think that's one issue. Now, when it comes to this company, it is about $120 billion market cap. You have negative return on equity. You have enterprise value around $157 billion, which means there's about $38 billion in net debt on its balance sheet. That's kind of a lot. Free cash flow at about $13 billion. So where's a good free cash flow yield at about 10%? So that's kind of the big positive here is that really more of a cash flow perspective. That's the way I want to look at it. And that's the way I would look at these things is not just current cash flow, but current cash flow projections. So with Bristol Myers, all of the pharma names, it's a challenge. It really is because there's a lot of these have patent cliffs, and you obviously have a new administration that's with RFK pretty hostile to the pharma industry. And I think that's why you are getting what looks like a bargain here, okay? And is because either their patent cliffs going forward, the pressure downward on drug prices is also political football. Now, Trump did just come in office and allow some drug companies to raise prices. So, that's kind of a positive, probably why Bristol Myers was up $2 today. Now, the technicals look good. It's in an uptrend. I like it based on a free cash flow yield. That's good. I don't love the debt. I think it's a little elevated. But overall, if you're looking for a pharma name, I don't mind it. I think it's one of the better ones out there based on the current price. And so I would give it a thumbs up. But know that all pharma in the age of Trump and RFK, it's called the Maha age, right? These companies could certainly be in the crosshairs as time goes on, which means that this is at elevated risk. Thanks for the call. Now, hope you're telling your friends that our audio podcasts are now available in video form over on our YouTube channel. So don't hesitate to head over there, check out our market update, check out our caller questions, as well as our main focus point. But we get questions submitted over there. And Blackberry7 says, "Hi, Luke and Justin. Love your show. What are your thoughts on Lindsay Corporation, LNN, and what would be a good entry point?" All right, let's take a look at Lindsay Corporation. And this is a smaller cap name, about $1.5 billion market cap. Now, what do they make? They manufacture self-propelled center pivot lateral moving irrigation systems used in agriculture. Now, one positive here, the big positive, is that ag prices are headed higher. So if you go look at one is I usually follow was DBA. That's an ETF. That's the Deutsche Bank Agriculture ETF. And it's been an uptrend since the beginning of last year. And it's continuing to move higher. So I generally like the ag space, and this is going to be tied to that, right? Because if ag prices are up, farmers are making more money, and they have more incentive to go out there and buy new equipment and maintain their equipment, and so that they can continue to produce crops. And so I generally like companies in this space. Now, return equity about 14%. They have net cash on their balance sheet. I like that. Cash flow about $64 billion on a $1.5 billion market cap. That's not a great free cash flow yield, but somewhere around the 4% level, not too bad. 1% dividend yield, but only a 24% cash dividend payout ratio means that there's a lot of room here for that dividend to rise. And they have been increasing their dividend consistently over the past decade plus. So I'm a fan of their allocation of their capital from the dividend. What are they doing with that cash flow? They're also buying back shares as well. So I like that. Let me look at the chart here. LNN is the symbol, just for everyone out there. And yeah, this had a recent spike. It's a bit overbought near term, but on modest pullbacks, I generally like it. It's a very volatile name as a small cap, so you have to be comfortable with that volatility. You see, just recently it went from 130. It went from 115 to 130, back down to 115, now up to 139, and that's all in the span of a couple months. And so that volatility for some people may be too much, but overall, I like it. I like the space that it's in. I like the balance sheet. I like the profitability, and I like the ability for the company to raise its dividend. So LNN is a thumbs up. Thanks for the call. Now let's touch a bit on the fires here in California and how that might impact those in the rest of the country. You might think you're far away from it, but the reality is that these insurance companies, they tend to find ways to make up the losses for these big events. And the wildfires are estimated to bring $20 billion of losses and liabilities for these companies. And Hurricane Milton and Helene, they were $50 billion combined. Okay, so just in the past roughly year, there's been some major natural disasters that are going to hurt some of the insurance companies. And research says that these large scale losses are not just going to affect those in the region that are exposed to wildfires in this instance. Because Harvard Business School did a study, and they found that big natural disasters like this impacted rates in other parts of the country disproportionately. So what's happening here is that insurers are trying to recoup their losses. And what it shows is that in states where the insurance regulator is pretty lax, that's where they tend to up the rates the most. Now, regulators are supposed to make sure that rates in the state are commensurate with doing business in that particular state. But the reality is different. Places like Vermont, Virginia, they tend to have lighter regulation, and that's where a lot of the increase in the insurance bills are felt on a percentage basis. And what you're seeing now is natural disasters are becoming more common, and the damage is becoming a lot bigger. So between 2009 and 2019, natural disasters led to annual premium increases in the following 2 years between 3 and 6.5% in states with looser regulations. Okay. And then ones with similar level of risk, but tighter regulations, they didn't see as big of an increase. Okay. So that's how it's passed on or not passed on, depending on how loose those regulators are. Now, the number of disasters are increasing. The number of disasters that caused $1 billion in damage or more averaged 13.1 in the 2010s, up from 3.3 in the 1980s. That's dramatic. And just here in California, the average of one of those events, $1 billion or more, each year from 1980 to 2004, that was the average. But from 2019 to 2023, the average was 1.8. The average was 1, now it's 1.8. So it's nearly doubled here in California. And for the first 9 months of last year, insured losses for total natural disasters in the United States was $89 billion. That's up from the 21st century average of only $49 billion. Okay. And so this is a trend that isn't going to change. And what you can see is regulators are allowing these costs to be passed on to other parts of the country that aren't really affected by a lot of these natural disasters, don't have the same risk profile as here in California or down in Florida or the Gulf Coast, et cetera. And, that's something you have to consider. It's not just, you live in Michigan, for example, or Vermont or Virginia, these are areas that you could still see an effect from these natural disasters. Now, what is the typical cost of homeowners insurance? Well, it's about 0.5% of the home's value. Okay. But in high risk areas, that can be 3 times that average. So it does vary. It doesn't mean that people in California aren't feeling this and they're not paying a premium. We are. It's just it's not equally distributed, right? They might raise those high risk areas, but they get a lot of it too from the lowest risk areas by raising those bills. So pretty interesting stats that we see over there on the insurance side. Now let's pivot back to the InvestTalk voice bank. You know the number to call your question at 888-99-CHART.
Good morning, Justin and Luke. Jeff here from Maine. Love the show and happy belated New Year to you both. Was just calling as I know in particular you guys aren't fond of airline stocks. You referenced capital intensive, low margin. And I just had a question on Delta Airlines stock. I saw this come up on a best picks list recently and wondering, what are the positives that somebody might be seeing in this company versus, what your guys' thoughts are. And maybe you guys think it's a good time to buy Delta stock. So, yeah, my question was regarding Delta Airlines and look forward to hearing your response on the show. Take care, guys.
All right. Well, I will say this about the airline industry. It has transformed a bit throughout the years, and frankly, it has nothing to do with the bread and butter of being an airline, moving passengers safely. And it has everything to do with points. That has become a big driver of profitability within these airlines, which is when you earn points and say you book with those points, they make an edge there. Okay, they make an edge with the credit card company that you might have those airline credit cards. They make some margin there. If you book through their website or using their points, with and they usually have a partner like Expedia or something like that. They get a cut there. There are just a lot of ways that they utilize that system in order to make money. So that's really the only positive about that, is how well can they capitalize on the point system that they run, that runs through the airlines and through miles and the credit cards that they operate, et cetera. And so that's really the only thing that's attractive about the airlines, because it's still capital intensive. It's still competitive. Now it's they have algorithms that help with pricing a little bit more now. So that's certainly helpful. But it's still generally competitive. It's very capital intensive. They have obviously a risk with higher fuel costs, higher labor costs. Strikes from airline pilots and those that work the mechanics, et cetera. So there's definitely some pressure on that front, but it's really all has to do mainly with those miles. And so with Delta Airlines, they do have a good miles system, but earnings do tend to wax and wane. You see that in 2020, they made $7.32 down to $3.20 in 2022, $6.25 in 2023. It's supposed to be up to $8.44 this year. So of the big airlines, they're definitely one of the better run out there. I just don't love the volatility. Obviously, you have risks of terrorist events, crashes, oil spikes, things like that can really take these down. So really, I don't think they're great risk versus rewards. If you want to own something that makes money off of transactions, for example, you might want to just own credit card companies, Capital One, et cetera. You might want to own, a bank. Those are probably better risk versus reward than these airlines that have so many other types of potential issues that create a lot of volatility. So definitely improved from the old days of just moving passengers safely. They've kind of layered on some other ways to make money, but overall, it's still not a great business.
We appreciate your time.
If you enjoyed this video, please like and subscribe for more engaging content in the future. Now let's go take another live call from Wisconsin. And this is Luke, and he is asking about EVVTY. And you're listening on Spotify. How you doing, Luke?
I'm doing well. Thanks for taking the call, Justin.
No problem. So you're looking at Evolution, and this is a B2B provider of live slot casino systems, correct?
Yes, sir. Yeah, and they seem to be really good financially. I was just curious, your thoughts on that industry as a whole, and then, a potential entry point for this stock.
Yeah, this was interesting. I think you might have emailed me. I thought I replied to it, but maybe I didn't. But I remember looking at this, and this was an interesting name because it's a foreign name. It's out of Belgium, if I remember correctly, and
yes,
they allow they run live. They have live dealers, and you can log in and you can basically feel like you're playing blackjack with a real person, because it is a real person on the other line, and you can run these table games with a live person, and you can place your bets. And so that's an interesting way of expanding gambling throughout the world. And their business is very good. Like you said, their financials are very strong. But the issue, I think, in the short term is, why is this in a downturn? Right? The financials are good. Free cash flow, $1.2 billion. And that continues to head higher, although that growth is slowing. Profitability, return equity is 30%. They have no long-term debt here. Free cash flow yield on a $15 billion market cap is in the high single digits. That's pretty good. Nice dividend yield, about 3.25%, which is a 50% dividend payout ratio. That's good. But the main thing is their exposure to Asia. They just have a lot of exposure to gamblers in Asia. And if you're talking about China and China's economy might be slowing, you could see gamblers slowing as well. So that's the big risk here. And, I would want to see some strength in the chart. Okay. Because history tells me when the fundamentals look good, but the chart looks terrible, the market is telling you something and you have to listen to the market. So it's a name that I keep on my watch list because I do like the business. I like the fundamentals here that I'm seeing, but it's also not listed on US exchanges. So how comfortable can you be with those numbers and doesn't have the same audit requirements as, a company that's listed on the NASDAQ or the NYSE? That's a big question. So I would keep it on my watch list. I wouldn't buy it yet. The technicals remain putrid. It's below all the major moving averages. It's in a downtrend. And this could easily go lower despite what the fundamentals are saying here. So yeah, I would pass on it for now, but keep an eye out for a trend change. And if you get that trend change, then I would probably pick it up. Thanks for the call. Now, lastly, let's talk a bit about private equity. And what's interesting about the private equity space is that there's continued push for transparency. And it's from not just the average person that gets pitched private equity investments through one of the major brokerage companies, but from pensions that are typically invested in a lot of this. And these pension funds have really been the big buyers of private equity. North American private equity funds now manage $4 trillion in assets, and mainly investments from pensions, endowments, charitable foundations, et cetera. And that amount has doubled in private equity since 2018. But what's interesting is that over the past decade or so, the amount of assets in private equity has tripled. But fees have gone up sixfold, okay? Which doesn't really line up. Why? Well, first off, they're running some financial shenanigans to kind of boost short-term gains. And this is where it goes down to accounting practices. And there's just not a lot of transparency or uniformity on how these returns are quoted. And so because of that lack of transparency, you don't know if you're in a good private equity fund or a bad one or a middling one, okay? And the median fee still is 2%, even though they're giving discounts to the large players who continue to fund that industry. But your average person, like I said, if you're an average person in private equity in a pitch to you by a Morgan or Merrill or one of the other big brokerage firms, you're still paying probably around 2%, which is very, very high. You may not see it because within that fund, but you are being charged it. So that lack of transparency continues to be a worry for me and many in the industry. So be wary when you are pitched those ideas, and make sure if you have heavy exposure there, look to be finding ways to diversify. Let's just say that. Well, that about does it. I'm Justin Klein. This is another InvestTalk program. We thank you for listening, and be sure to rate and review on iTunes. And you can find your episode of InvestTalk anytime at iTunes, Spotify, Google Play. And if you need help understanding your financial picture, your portfolio dynamics, and dialing in a strategy that makes sense for your risk tolerance level and your goals, I encourage you to schedule a free portfolio review assessment with me by heading over to investtalk.com, clicking the portfolio review button and filling that out. And if you need help optimizing your 401k, we can help with that as well. Independent thinking, shared success. This is InvestTalk. Good night.